Okay, so a big good evening to all the people in God's own country, right? So it's great to be here. I've been visiting Kerala as part of my previous job when I was the head of sales and marketing at Canada Robeco. And 2 years back, I took up this new assignment, and very, very happy to be here, to be invited by AIFA, governing council, the members here. Beautiful location, and I hope all of you have been having a good time. Last one day and another one day to go, or so much of overload of information, market gyan and everything. So some bit of gyan from my side also is what I'm going to share. Am I audible at the back, please? Yeah. Okay. So what I'm going to do is, it's good I came in a little bit early. I also attended a few of the presentations, and I found that a lot of valid points have been, already taken up. Yesterday's sessions, I'm sure, would have been equally impressive and good, and a lot of information to take forth. I'm going to stick to the time, and just, what we are going to do here is look at what is the context, set up a perspective, because the importance of context and perspective cannot be ignored, especially in a business which involves so much of relationship management, right? We all agree it's about managing relationships with our clients, taking them in this long journey of wealth creation, and it's so very important to have a context and a perspective. Then I thought we are going to look at controlling the controllables. Okay, what is it that's for us to really influence, and what are those things where, in spite of being in God's own country, I think we leave it to fate or luck or to experts, basically. Okay. Before that, I'm going to take 2 minutes to just tell you about Bank of India Mutual Fund, friends. This is a company that was formed in 2007, earlier as Bharti AXA, and then in 2012 it became BOI AXA, where Bharti Group exited this, and in 2021 AXA exited the mutual fund business. They also exited the mutual fund business globally, and this is now a 100% subsidiary of Bank of India. We have 19 products, 17 open-ended products. Please do look us up on the performance charts. I think you'll find us doing well. And for those of you who've invested with us for your clients, I think we've created a good, track record in terms of long-term wealth creation. But most importantly, I think the focus is on being true to label. We are a growth-oriented investment philosophy. And I think there's a very, very big focus on managing risk in the form of managing concentration risk and the liquidity risk. Because, friends, we are dealing with open-ended mutual funds. Money can come in and money can go out equally fast. Okay, so it's important to ensure that the drawdowns that we have in our funds are limited to the extent we can limit them, and hence a very, very tight eye on keeping the concentration and liquidity risk under check. So we are a fast growing AMC. I must also tell you that over the last 2 years, 3 years, we've kind of gone up from 5 times, from 2,000 crores to now close to 11,500 crores. Our SIP book has grown from about 5 crores to close to 80 crores now per month, and very happy to share that our folios have also been keeping fast pace with the industry. And while our overall share of the market is just about 0.16%, we are clocking about 1% in net sales if you see the last financial year. So I think that gives you comfort, and all of it is mostly retail money. Okay. So with that, I think enough about Bank of India Mutual Fund. I've already completed 4.5 minutes. And I'm going to now talk about the topic that I thought is maybe of interest to all of you, which is how can we focus on the controllable and create a framework for getting a winning edge for our clients. So this the contents. Like I said, having an eye on the context and perspective is important. Why it's important in today's days and age to demonstrate advisor alpha. When I say advisor alpha, it includes the MFDs, it includes all the financial consultants that investors go to, and also a framework for creating your winning edge. So friends, this has been enough talked about and debated, but let me tell you, the big thing that we all have been talking about, and I'll come back to this in the last slide, is about keeping the eye on the big numbers. Today, this is a busy slide, may not be visible at the back, but the important thing is India leads the world in terms of the fastest growing economy, and this is going to continue for a long while. And the more important part is the second best is quite far behind us. So when we talk about a real GDP growth of about 6.5%, 7%, the next best is at least 1.5% behind us. And when you add inflation, you look at the nominal GDP, we are in the 10 to 12% range. And that's what something Akhil talked about earlier in the afternoon, that typically this is the nominal growth rate is what results or translates broadly into the return on equity in companies. And this is what really translates into long-term returns in the share market or mutual funds that you see, okay? So this is setting the context. Again, a busy slide, enough has been talked about, but I'd like you to focus on the line that captures the nominal GDP and the line that captures the Sensex, okay? This is slightly dated because it captures the financial year end, but what we get to see is, as the GDP has doubled over decades, okay, the last 4 decades, we see that the markets have typically gone up by 3 to 4 times, okay? So that's the big picture, that's the context in which we are working today, and that's something that we need to keep in mind. So this is something about the perspective, okay? It's important because we are managing money for people, right? We are managing relationships. So, and it's about that story of, seeing the glass half filled or half empty, right? So this is an aerial shot of, the city that I come from, that's Mumbai. So the left 2 pictures tell you what? A city in problems. There is, a lot of these, shanties. You see, problems to kind of build up roads and all. And this is the beautiful part, right? So here you see challenges, and here you see that converted into opportunities, right? So today, and why I'm mentioning this is the coastal road today, which starts from Bandra Worli Sea Link, and it's been extended further north, now takes you to town in less than 15-20 minutes, which used to be earlier a journey of 1 hour. So this is the perspective that we need to show to clients who are sometimes too cynical about the story of the markets or story of India. And I hope all of you believe in this, right? But these are examples that help you set the context and perspective. Okay, let's come to the second part, which is the need for demonstrating advisor alpha today. We see that financialization of savings is something very big that's happening in India, right? So we talk about physical assets, we talk about commodities, and we talk about money coming into market-linked products, right? So this is, friends, the big mega trend which we think is going to continue for the next 2 to 3 decades in India. 2 to 3 decades is agle 30 saal, right? Or more. And this is the big opportunity for all of us, and market-linked products like mutual funds, which have built a track record of great performance, long-term transparency, tax efficiency, regulatory benevolence, and abiding by regulations, I think is therefore, I would say, going to be the fastest or one of the fastest growing categories here. Product innovation and complexity is a boon for experts and seasoned investors, and like Chatty said, people who invest in knowledge. It could be a problem if you're not keeping up with what's happening in the market. Market cycles are getting shorter, and so you need to make sure that you are well informed about the changes. And friends, let's not forget that today we have 1.4 billion journalists in India. You know how? The WhatsApp market, all of us have WhatsApp, right? So information gets exchanged so fast, and that's where hand-holding for the clients is important. Independent advisors and distributors stand out as a fraternity because, you are in the business, your bread and butter comes from this, and people trust their advisors more than they trust, some of the other bigger institutions at times. So what's a framework that we can create to have a winning edge? So I'm going to talk about 4 things, friends. It's going to be allocation, selection, timing, and behavior, okay? So those are 4 areas, And I thought each one has its importance, but we are going to look at what is the context of what's the item we can control. Is it visible or should I step down? Okay. So friends, asset allocation, all of us know. How many of you think that asset allocation, if you've done, your job is resolved? Nothing else requires to be done. Raise of hands. Partly true. Okay, partly true. Because asset allocation, we'll come to that, is nothing but balancing the risk and the return through the allocation between various securities and then asset classes that you do, various asset classes that you do, to basically arrive at the weighted return that your client wants over the long term, right? So we'll keep it simple at that. And again, the idea of showing this CAPM curve here, which is simply speaking rate of return and risk tolerance, is to tell you that our job as advisors or people who are talking to clients on a day-to-day basis should not be getting disturbed by the noise, but focus on, what is the, core message or core music, which means that once you've decided the risk tolerance level, you can work out the returns that your assorted set of asset classes will deliver. But then your effort should be, don't try to add in securities or asset classes that kind of bring the returns down or increase the risk, okay? If you're increasing the risk, the returns have to kind of go up. So you have to be going up the curve, right? So that's, in simple words, you need to be going up the curve when you're managing the risk and return. And isko zyada humne complicate nahi karna. Risk is nothing but the band of returns or variation in the returns that you can see, right? And while rate of return, historical data is not an evidence, but historical data across a large set of securities in an asset class and across long periods can give you a fairly good indication of what the likely returns are going to be. So we're going to match that. And then we said selection edge. What is the selection edge? The funds that you select, right? In a portfolio of equity securities, the equities you select, or in a portfolio of mutual funds, what's the mutual funds that you select? So friends, when I was talking about asset allocation, let's remember that asset allocation is responsible for 100% of the level of returns. Okay, there's been this cliche that 93% of the returns come from asset allocation. No. That's a different research. I mentioned it. You can please look this up on internet. It's freely available research. But what is true is 100% of the level of returns are going to come from asset allocation. What does it mean? That if you have to really beat inflation, you have to be largely in equity. Of course, debt is important, like Chatty mentioned, but you have to have asset classes which are going to beat inflation by a large amount, right? So level of returns 100%, which means if you can't run a Formula One race in an 800cc car. You have to have a Ferrari to run a Formula One race, which means that that's the kind of asset you should have when you're deciding your asset allocation. Finally, this is an important point, the third point that I'm mentioning here. About 40% of the performance variation across funds comes from asset allocation. Where does the rest come from? Security selection, cost, timing, and other factors. Are you surprised to see this? Because all of us thought that asset allocation is fill it, shut it, and forget it. It's not. Your fund selection, the time, the cost, timing, other factors are important. So I was also surprised when I saw this for the first time. And what I did was basically I looked at comparing the returns for two kinds of portfolios. One portfolio, which is the conservative portfolio, which has 70% debt and 30% equity. And then I looked at another portfolio which had the reverse, 70% equity and 30% debt. And we tried to, take the last 5-year and 10-year returns. These returns are updated till September 30th, 2024. And it is basically all the funds in a particular category. So we picked up funds and the large cap category, mid cap and small cap, short-term debt and GSEC. So this is 100 lakhs or 1 crore rupee divided in this ratio of 30-70 in the, 70-30 debt equity in the conservative portfolio and the reverse in the aggressive portfolio. So these are the results for the hypothetical results for a conservative portfolio. What do you find here? Too many numbers, right? But the important thing is the best funds, if you were in a portfolio of best funds, your returns would have been 2.18 crores. If you ended up choosing the worst funds, you would have been at 1.6 crores over 5 years. If you had chosen 10-year horizon, then the best funds portfolio would have generated about 3.24 crores and the worst funds would have been 2.41 crores. So that's the power of selection, right? Now, this is a revelation. You look at the aggressive portfolio. Now this has 70% equity and 30% debt, okay? Look at the change in results. The worst value is 2 crores and the best value is 3.17 crores over 5 years, okay? The worst value in 10 years is 3.17 crores. The best value is 4.69 crores. Almost a 50% difference in returns over 10-year period. So, and the difference is more stark as the equity component increases. So what does it tell us, friends? It tells us that if your portfolios become more aggressive, if the risk in the portfolio builds up more, which you have to, if you have to beat inflation comfortably, then it is really important that your funds that you select are going to be good, okay? Now in hindsight, all this looks easy. And I'm not saying you will end up choosing the best portfolio, but the point is, can we do a review, maybe once every years, once every 3 years, to look at, where are you going? Okay, the third, and this is something that I've done a few times in a few places, to time or not to time. I think that is something that comes on everybody's mind, and that's why you hear these questions in the audiences that we go, कि कल market कैसी लग रही है, अगले 6 महीने में market कैसी लग रही है, right? So what I'm going to do is play a little game. So some of you would have done this in the past in one of these sessions, but I have a very simple game. I have 80% of the cards which are green and 20% of the cards in my box which are red. I want to just ask 1 or 2 volunteers to just pick up or tell me which card is going to emerge next when I, click the button, okay? The hint here is it has something to do with what our markets, how our markets behave, okay? So here we go. Any volunteer? You're right. How about next? How about the next one? Red? Okay. So since I'm running out of time, I'm going to paste this up. Typically, if we have 80% green cards, right, and 20% red cards, I gave you a hint. This is about how the markets in India are likely to behave in the long term. How many of you think, so we talked about setting the context, right? Indian nominal GDP is going to be in the 10 to 12% range. Does everybody agree? Yeah or no? Come on, yaar, itni baat ho gayi. We have been talking about India, the growth story, so many numbers. Yes, if you are talking about a 6 to 7% or 5.5, 6% kind of GDP, which is real, and 5% inflation, you're going to see that 12%, right? And if that 10, 12% is the nominal GDP, you see a return of equity delivered by companies which is in the range of 13, 14%, which translates into the return in the equity markets, right? So, chalo, I'll ask you a simpler question. How many of you think we can generate a CAGR of 12% over the next 15 years or 10 years? Very few hands, yaar. The government is not going to like this. So a lot of us, right? A lot of us believe that we can generate, when we talk to clients, what do we say? We can generate 12 to 15% CAGR, right? Okay. So we think that there is a very strong probability, maybe 70 to 80% of generating this kind of returns in the market, which is 12 to 15%. And there is very less probability that the markets will be, on a continuous basis going down. Okay? So if you have this kind of a market scenario, what should be the optimal strategy? Remember, there is a 70-80% chance of probability of the markets going up. There is a 20% probability of the markets going down. So mathematically, friends, the best strategy is you don't try to guess the red. Right? So what does it mean? Staying put is better. Every time you try to guess red, your probability of, riding the complete upward wave comes down by a little bit. Okay? It is also true. Please think about it. Okay? So remaining invested, if you have this kind of a scenario, is the best strategy towards timing. Yes, you can use timing towards, if you are too much worried about the day-to-day or the month-on-month volatility, but frankly, if you ask me, I am not a believer in daily SIP or daily STP if the money is there for 5 years, 10 years, 15 years, right? And this is the time today to think about the next, 20, 25, 30 years and not the next 3 to 5 years, okay? And because a lot of wealth can be created. And again, I'm going back to Akhil's presentation in the morning. He was telling you about compounding over the next 25 years. So use timing in the way best we can use it. The behavioral edge, okay? So this again, I'm sure a lot of people would have spoken about it, but this is a survey from the CFA Institute which talks to you about, the typical behavioral biases that you see from customers, the number one being herding, and you experience it. If your client's friend has invested in, the latest thematic fund, he also wants to invest in it, right? So that's herding. And confirmation is sometimes people trying to just go back and to their past experience and trying to repeat that, which may not sometimes be true. But I'll leave it at that. But this is also a presentation with your governing body. You can please use it if you want. But these are things that you'll encounter very commonplace. So summing up, what are these controllables? So I've tried to order them in the descending order in terms of the control that we have. And this is also important, this line, investment markets are micro-efficient and macro-inefficient. This was said by Paul Samuelson, a very famous economist. What it means is, let's not hunt for these small opportunities which we call arbitrage. Arbitrages, not the arbitrage fund, but arbitrages. Let's look at macro inefficiency. I like the idea that debt investing in India, where you know that large flows are going to come over next few years, there's a certain opportunity to be built up in terms of debt allocations and market valuations looking rich. So if you have doubts, park some money in debt also. Okay, that's a macro inefficiency that you're going to use. So for example, a macro inefficiency which a lot of the foreigners ignored or even Indians ignored, right? If you knew this market was going to go like this, you would not have been doing a 5,000, 10,000 rupee SIP. You would have been doing a 1 lakh, 5 lakh rupee SIP, right? So those are macro inefficiencies or bigger trends which don't disappear in a day. And those are the ones that we have to capture. Friends, from my perspective, I think asset allocation is the biggest control that you can have, right? Because that dictates the level of returns that you're going to generate. So that's the biggest controllable. Persist to resist the behavioral biases, both yours and your clients. I think these are the ones that will tear you away from the kind of returns that you had proposed for your client, okay? So please persist with ensuring that your client doesn't fall into behavioral biases. Fund selection, I showed you the results here. It can make a lot of difference. Today, instead of going into these calculations, go into the results of the large cap funds. You have some 40 large cap funds. See the difference over 5 years, 10 years. There is a 3 to 4 difference of percentage difference of CAGR. Go to the small cap funds, which is the higher risk category. The difference in 5 years is almost 15% CAGR. Okay, that is per year. So that's the power of fund selection, and that's where value add can come in from seasoned advisors like yourself. Time spent, like I said, timing, not much you can do. And we are lucky to be in India. All of us lucky to be in India in this time, in this profession. Because you have such a strong probability of the market's likelihood of going up and delivering this double-digit kind of nominal returns, that it doesn't make sense to stay out of the markets. So hence, I think spending time in the market, the old adage, is going to work better. And there are two other essentials. क्योंकि आप लोग सब कुछ सुन रहे हो, मैंने भी बहुत कुछ बोला, and there's enough to learn from everybody. the importance of knowing the big picture. So this is again a story of 6 blind men, each one trying to build up a perspective of what he can see. But getting the big picture right is going to be important. Chatty showed you the Kerala market, how it's grown. We are talking about the number of folios, the way they have increased. Okay, we are talking about markets growing big. So the picture is not for the next 6 months, 1 year or 5 years. The picture that you take to your clients is for the next 20, 25 years, because we are all trying to help clients create wealth. Finally, this is a quote that I like from this famous poet, William Ernest Henley. So this is his poem called Invictus. उसको अगर मैं हिंदी में ट्रांसलेट करूं, sorry I didn't learn the Malayalam version of it, is सुनो सबकी और करो मन की. Okay? So listen to everything, but do what is right for you and for your client. With that, I'd like to thank you all. Thank you very much.
Thank you, Mohit ji, for that lovely, lovely presentation. Request you to kindly remain on stage. Can we have to join Mr. Mohit Bhatia on stage, Mr. Vinay Kota, Regional Head South. Also calling in Mr. Balakumar Nandishwaran, Manager, Bank of India Mutual Fund. We have just heard Mohit ji talking about the importance of asset allocation and also the need to take some risks. And I'm very, very glad and happy to announce on behalf of Mohit ji that please have a look at their mid and small cap equity and debt fund, which has crossed 1,000 crores of AUM now. Mid and small cap equity and debt fund. It has got mid cap, small cap, equity, debt, crossing 1,000 crores. And now we have the lucky draw sponsored by Bank of India Mutual Fund. Can we have the lucky draw box, please? Requesting Mohit ji to pick up the lucky number. Number 168. Number 168. 168. Mr. Shivraj Ganesh. Before Mohit ji leaves the stage, I would like to welcome and introduce to this august audience the newest baby in BOI Mutual Fund, the new joinee into BOI Mutual Fund, Mr. Vinay Kota, who has taken over as the regional head for South, ably assisted by his deputy, Mr. Balakumar Nandishwaran. Please give a big round of applause for Mohit Bhatia ji, Vinay Kota, Balakumar and BOI Mutual Fund. Can we have Mr. Prajit from AIFA Kozhikode chapter to kindly come forward? Mohit ji, please receive a small token of our gratitude to you.